Good morning. We will pay attention to the final accounts of sole traders. We will pay attention to the final accounts of a service enterprise and then on the final accounts of a trading enterprise. The final accounts are normal ledger accounts, so it's T accounts drawn up according to the double entry principle. The income and expenses accounts are closed off at the end of the year and transferred to this final accounts. The names of the contra accounts must appear in the final account. That means if you transfer salaries and telephone, water, electricity to the final accounts, in the final accounts you must indicate what is the expense. So you will say salaries, trading stock deficit, etc. Only the net sales, cash and credit sales, less debtors allowances, are shown in the final accounts. So you don't show the cash sales as one figure, credit sales as another, and the debtors allowances as another figure. You will have one sales account in your books, and at the end of the year, the debtors allowances is closed and transferred to the sales on the debit side, and then the balancing figure in your sales account will be transferred to the final accounts. So there will never be a debtors allowances amount in the final accounts because you close it off to the sales account. The income of the enterprise will appear on the credit side and the expenses on the debit side of the final accounts. So we've learned from the beginning that income always increases on the credit side and the balance is on the credit side. Expenses increase on the debit side and the balance is on the debit side. So we will do exactly the same in the final accounts. Income will appear on the credit side and expenses on the debit side. The net income will be credited to the capital account. So after you've taken all your income and all your expenses into account, you will calculate what is your net profit. The owner is entitled to this profit, therefore we will transfer it to the capital account, and now the owner's interest or equity will increase in the business. The drawings account is also transferred to the capital account, so the drawings account has a debit balance, therefore we will debit the capital account and credit the drawings account to complete this closing transfer, to transfer the drawings to the capital account. And net loss will decrease owner's equity. So after the nominal accounts were transferred, all the balances in the nominal accounts are closed and there will be no balances in the nominal accounts. If we look at the profit and loss account, on the credit side, we will have all the income of the business. On the debit side, we will have all the expenses of the business. Then we will add up the credit side, get the total, subtract the amounts on the debit side to determine what is the profit that we made. And this profit will be transferred to the capital account. The main income of a service enterprise is called current income. It can also be called commission received if your major income is out of commission, fees received, services rendered. But you don't buy goods with the purpose of selling. You only render a service to get an income. Therefore, you will not have a trading account. You will only have a profit and loss account. In a trading business, you will have a trading account so that you can determine what is your gross profit. We will transfer sales to the credit side. This sales figure includes cash sales, credit sales, less debtors allowances. And we will transfer the cost of sales to the debit side. The balancing figure, so the difference between sales and cost of sales, will be transferred to the profit and loss account, and that is the gross profit that we made. So that 18,200 will go to the credit side of the profit and loss account. Then we will transfer all our income accounts, so we close our income, transfer it to the profit and loss on the credit side. we will close all our expenses and transfer it to the profit and loss on the debit side. And the difference between the debit and credit side will then give us a balancing figure, and that is our net profit. The whole purpose of a business is to make a profit that the owner will get, so this net profit will be transferred to my capital account. The profit in the profit and loss will then go to the credit side of my capital account. We will start with the opening balance, that's the amount that the owner contributed, plus the profit that was made during the year. So that means his equity is 36,053, or that is the amount that the business owes him. But he's already taken goods or money worth 4,500. So he reduced this owner's equity with 4,500, and then we work out the new balancing figure. So it means the figure that will be recorded in the balance sheet as owner's equity will be the 31,553. And the following financial year, you will start with that as an opening balance of capital. What is the steps that we've learned? You first have to close your debtors' allowances to sales. Then you will close the sales account to your trading account. And you will close your cost of sales account to the trading account. And then the difference between the debit and the credit side will give me the gross profit, and I will take this from the trading account to the profit and loss account. Then we will transfer all our expenses to the profit and loss, and we will transfer all our income to the profit and loss. And the difference between the debit side and the credit side of the profit and loss will give me the net profit, and that net profit will be transferred to the capital account. To determine how much money the business owes the owner, or what is his equity in the business, the drawings must be taken to capital so that a balancing figure can be calculated to determine what is the equity at the end of the year.